Good morning, and welcome to the Nedgroup Investments Stable Fund third quarter update. I'm joined this morning by Nick Balkin from Ford Asset Management. Ford have been managing the fund on behalf of our clients since inception in 2007 and have done an excellent job of producing strong returns both in absolute and relative terms. Indeed, their track record of outperforming inflation plus 4% over rolling 3-year periods while protecting capital over a 12-month time horizon is exceptional. Nick is a senior member of the investment team at Ford and is a multi-counsel portfolio manager on the Stable Fund. Before I hand over to Nick, I would like to mention that you may type your questions and comments into the chat box on the right-hand side of your screen. We will try to answer as many of these as possible before we close for today. Nick, good morning, and thank you for joining us.
Thanks, Anil. And thank you, everyone. It's really great to be here. So I have only got 15 minutes to give a bit of an update, and then hopefully the juice will really be in the question and answers. So I think given that it's 15 minutes, I think I'll try and shoot through it as quick as possible and leave the interesting stuff for Q&A. I think on the performance side of things, Anil did allude to it, but we're very proud of our performance, both in the short term and the long term. As you can see, we've got an 11% return over the year in what is a maximum 40% equity mandate. So we're very pleased with that performance, but more important is the long-term track record, and that 9.5% is something we're very proud of, as you can see, over 10 years, but more importantly, also number one over 50 funds. So that's really good performance over short and long term. That doesn't come from anything we did this year. In fact, a lot of the things that happened this year were things we've been talking about for many years, actually. So this is a bit of fruits from positioning previously. Just for a bit of context, I think on the performance, we don't love doing attributions. We think contributions are probably a better way to look at the performance. We've circled the interesting piece of the performance. As you can see, JSE equities did a negative return over 1 year, property did a negative return, but the real weight of the portfolio, the 46.8% is in interest-bearing asset class, with a lot of it in bonds, and then the other asset is just gold, so almost 5% in gold and 34.3% in foreign. And that important positioning in the three positive buckets of performance really did help the performance for the year. So I think let's go into each one in a little bit of detail. Try just check that the mute doesn't, there we go, that worked perfectly. I think if we dig into that detail of the performance, you can see the main lines, as I said, and it's interesting context behind the performance, because you can see that the SA other assets, which is the gold, the foreign, and the fixed income, did all the business, and we had very low weightings in the SA equities and property. So that's just a asset class return movement through as the year went. We know what happened in February and March, and actually there was additional protection in there as well, which I'll get into in a few seconds. This is just another chart, a takeaway chart for your recon to our performance. This is now just the asset weight times the return, which will show you, the contribution through time over that year to the performance. As it says there, the Stable Fund did a great performance, and we're very proud of it. And it came from not only good asset selection, but also good performance in other ways, which I'll go into now. I think a lot of people think when Ford talk about the long term, we're big long-term holders, we buy and hold, we trying to look through short blips. They think that kind of means that we don't do anything dynamically, we aren't flexible, we aren't managing the risk on a shorter term basis. So I thought this chart would be a very interesting way to talk about that and kind of show that philosophy in action of protection, even in the short to medium term when we see the risks coming. So as you can see, the middle bar, which is the bluish bar, which is called hedged equities. You can see in January and February, the big increase in hedged equities. That was as we saw the risks of COVID coming in. There were many other risks that we alluded to. We ended up protecting a significant bucket of equity in the just before the fall came through, and that protected investors substantially. Subsequent to that, you can see that the pressure valve has released in Ford International, and you can see this. Sorry, this was a snapshot just to remind everyone of Ford International, which is a building block within Stable Fund, and how we manage that equity dynamically. More recently, you can see that the net unprotected equity exposure has gone up a bit. It is to do a bit with the way we see markets and making sure right now that we're in solid companies with pricing power that can actually continue to do well. And as cash almost becomes a losing asset through time, we think that we actually can protect in smarter ways in Ford International right now. Obviously, the last bucket, which I didn't speak about, is the precious metal bucket. You can see how big that was and how important a driver it was in the previous two slides. But it doesn't help if you don't have the equity selection side. So when I alluded to the global performance, we obviously protected on the one building block, which was Ford International. The other building block is the Ford Global Equity Fund, which is another key building block of the Stable Fund. As you can see, over the year, it's been, or just over a year, it's been a very good stock selection period for the Ford Global Equity Fund, with significant alpha both against peers and world index. So these are the top 10 performing stocks. We didn't name them. I'm happy to take Q&A on it. But I think the important thing is that it's not in your typical Amazons, Facebooks, etc. We don't have those stocks. The only one of the big, I guess, name stocks is Alphabet that we do have, which is an interesting, almost value play in the tech sector. Across. Okay, so I've taken you through Ford International, the building block, Ford Global in the building block. The other key thing is the bond allocation. Obviously, bonds have not, if you were allocated across the maturities, they've been good and bad places. I think this chart is very interesting. You know, the people that were reaching for yield in the very long duration, anything over 7 years in the SA government bond market, actually got a negative or very low return over the year. So what we did is we communicated quite clearly that we rather focused on a more predictable, stable return out of the mid-duration, the 3 to 7 year bucket. That's where we allocated a significant amount of our bond allocation. You can see that that's where the returns actually came through over the year. And that's been a key driver, not only of good selection, I guess, good allocation into bonds, but good selection within bonds. The last one is gold, which I have alluded to in the positioning. You can see it just talks about the genie being out of the bottle. I think Dave has spoken about it at a previous roadshow. The risks to inflation and the risks on stability in the world, given what's happening with the monetary printing, which is in red by all the different, I guess, reserve banks across the world, is leading to a potential further out, quite far down the line, of hyperinflation, which was alluded to previously. And the one way to protect it is making sure you do have a nice allocation to the gold ETF, which is very uncorrelated and performs very well in that hyperinflation world. So why is this? I think it's a very simple chart. I think it's, I just got to keep track of the time. It's a very simple chart. If you think about what is our job? Our job is to balance risk and reward for our investors, especially in the stable fund. It's a simple chart, but not many people pay attention to these things, and they worry more about the opportunity side and the excitement side to generate super returns every year. For us, we're trying to balance risk and reward, and risk being permanent loss of capital rather than volatility. And we think that the scales are tilted towards risk globally, especially if you're in the big indexes. You know, you own the actual index, you can't, I guess, stock select like I showed you in the previous slide. So we're saying that if you box smart and you can own stocks that are smaller, that are uncorrelated with the market, there really are ways to make money. It's a very good market for stock selection right now. But if you are the market, we just are cautioning that the risks are rising and the rewards are pretty scarce. So why are the risks high? I'm not going to go through all of those things. suffice to say that money printing is something that is very important to understand. It's not something that is going to create instability in the next 6 months, but we absolutely believe it's brought forward a lot of consumption in the current period as a result of the government printing a lot of debt, and a lot of that printing a lot of money, and a lot of that money has filtered its way directly into the consumer, especially in this COVID world. I've got a chart coming up, and I think what's happened is people are very surprised how resilient the consumer, especially globally and especially in America, has been through this COVID period. You'd think with that amount of job losses, unemployment over 10%, there would have been a bit of give. But the governments and the Federal Reserve and all the monetary authorities around the world have chosen to try and stop, I guess, cycles. We at Ford believe you can only postpone a cycle will come, and the earnings risks remain, the earnings risks are high. And that's why, as I said, we've got to box smart. We've got to be in stable companies with pricing power. We've got to have diversifiers like gold. We've got to have, the one thing I didn't mention is optionality in the portfolio, which you've spoken about before. The one question we might get is around the Rand. We believe the Rand, as we've spoken about many times, will depreciate quite substantially from the current level over time. Tactically, we remain protected to a certain extent for a small percentage of our fund on currency options. So we own currency options that will protect a portion of our global funds should the Rand temporarily strengthen. That will add to the resilience of the portfolio because we think that the equity market and the stocks we've selected in global will do well. And then we have this offset, I guess, of some Rand protection. So it's important to understand that when I talk about it, there are diversifiers across the portfolio that will make sure that the portfolio is hopefully going to be an all-weather portfolio, as Anil spoke about, and protect capital over the 12-month period also, although generating good returns. So why do we think that the debt, and why is this such an interesting chart? The debt being pumped into the world is absolutely keeping disposable income higher than it should be. So what is this chart? This chart, if you focus on the three bottom colors, the green, the blue, and I guess the brownish orange, this is American disposable income. If you see those three lines, they continued in an upward trajectory till COVID hit, then you saw them collapse substantially. The interesting thing is you've seen a few $1 trillion government transfer, which is the green bucket, accelerate. The only reason that actually disposable income went up, not down, in the COVID period is a government transfer of a few $1 trillion where their budget deficit blew out and they passed income directly through to their consumer. This is not a sustainable base to work from, in our opinion. In fact, you've seen record retail sales at a time where you'd expect the opposite. So I think those are the sorts of things that we are watching and I guess choosing to be more cautious. While the famous saying, while the music's playing, it's quite exciting to get up and dance. I'll forget his name, Chuck Prince said that at Citi. We try not to dance while we see a bit of music playing. So yeah, it's important to understand that there is instability still. It might seem stable, but this chart does highlight some of that instability. So what are we doing about it on the positioning side of things? It's very little change, I guess. There's we showed you the dynamic side, but I guess in the big picture over the quarter, there hasn't been a big move. Foreign assets remain at the 30% mark. That is with the netting position of the currency option. We got the big government bonds, the gold, which I've alluded to, which has grown slightly since then, and a very low equity weight to domestic equities. Having said that, the market has come off significantly, especially in SA incorporated stocks. It is something we're looking at. It's not to say that we're doing anything about it, but the Reserve Bank in South Africa have also taken the view that they're going to create cash is trash kind of world where the cash yields nothing. So it is, to a certain extent, we are finding opportunities which we're being very cautious about on the SA equity side of things, but we don't see it changing very much. It will be at the margin, maybe one or two idiosyncratic opportunities, but I think largely the current structure will remain in place, but we are being vigilant to opportunities in the, I guess, the sell-off in SA incorporated stocks. So with that, I think, yeah, hopefully I summarized our thoughts. I have got some appendices of interest. If a question comes up, I can point to it. And yeah, I think the real meat comes in the questions when you guys ask what you want of me. So I'll hand back to you, Anil, and you can take the Q&A if that's okay.
Brilliant. Thanks, Nick. So we are aware that some clients had issues getting in due to some technical issues. I mean, it may have been the Microsoft server and so on. But just a reminder for those of you who are on the call and for those of you who joined a bit later that you can type in your questions into the dialog box on the right-hand side of your screen. But just some of the maybe questions that did come through, Nick, if you can just, for the purpose of the people who joined late, maybe a very quick summary of some of your earlier slides, just so that the guys don't miss out.
Yeah, I think if I try and summarize our thinking, you know, the stable fund is there to produce inflation-beating returns on a stable basis through time. And I think it is an important part of people's portfolios when they are cautious about not losing money. And I think it's done its job from a performance point of view, both on the short term and the long term. There will be periods in the middle that there might be not exactly the benchmark performance, but we have cautioned about that. The important thing is that all the things we positioned in big foreign weight, high bond allocation, gold as a diversifier, all three of those did significant performance for the portfolio. Being underweight domestic equities did a good job because it was a negative contributor in the current period. The stock selection was good in global equity. The Ford International Trust protected when it needed to, and we were in the right place on the bond curve, being on the short to mid duration bonds. We accepted a slightly lower return, but we also didn't reach for yield to try and get the highest return, which ended up being a good thing because the mid-duration bonds were the best performing as people worried about the solvency longer term of SA government bonds. We think risks are high globally. We think that if you are in an index, it's harder to pick stocks that can perform in good and bad times. We can select stocks like biotech companies where the performance is actually linked to our stock picking ability rather than the market. I think this is the time for that. And I think that's something that we have done. Debt around the world is very high. It's produced a world where people don't understand the risks because it has created stability in retail spending around the world. South Africa has less of that help because our government haven't spent as much as a percentage, but our deficits are still high. And I think caution is important given all of that. So I tried to summarize it in a kind of bite-sized way, but I hope that helped. Our asset allocation is relatively unchanged, which I showed, but I think everyone might have seen the concluding slide.
Thanks, Nick. I mean, we will definitely make the recording available in any case as soon as possible. And Nick, just, I mean, given the mandate, it's quite an interesting mandate. You have the ability to be quite well diversified. So how do you think about portfolio construction and asset allocation and particularly protecting capital over that rolling 12 months period? It's not necessarily an easy thing to do, but you guys have done it so well over time.
Yeah, I think the important thing is it's not a cash fund, right? So I'm always trying to caution people, don't buy this if you think it is a money market fund because it has a max 40% equity. And in order for us to get the 10% return over 10 years, there needs to be some equity. So with that in mind, we try our hardest, and it's a good question, Anil, because we spend a hell of a lot of time understanding the correlations within the portfolio, how to diversify different risks out into the portfolio. If we have a certain amount of SA exposure in our bond market and our bond allocation, maybe we don't need a lot of equity focused on the same thing. You know, the simplest way to understand it is, you know, the JSE right now, we are looking at our global equity selection, understanding that we already have quite an exposure to China in our global funds, and we're making sure that we have a much smaller Asian or Chinese focus in our building blocks that aren't in global equity. So it's a key thing that Ford does well. The way we do it is having an absolute mindset when we own stocks, and understanding that diversification and matching different correlations reduce risk without sacrificing return.
Thanks, Nick. And just, you mentioned about Amazon and Facebook earlier on, and specifically that you don't hold it. I mean, what are your thoughts on that, and maybe bring in some of the philosophy around how you manage the fund?
Yeah. So I'm always cautious to say we don't or never, or I mean, they're wonderful companies. I'm not knocking them. We actually think, if you've listened to my pillar presentation, they're great companies. I just think, and having a certain exposure to the tech world is important, and we do have it, as I said. But we just think, as I spoke about that scale chart, it's about balancing risk and reward. And what we think in those stocks right now is, because of the debasement of money, that it's pushing people to seek growth wherever they can. When you've got a less than 1% 10-year bond in the US, you really are reaching for yield that the PE, and it's, you can just invert the bond yield, and then you get a PE of the 10-year bonds. You're operating on 100 PE if you buy a 10-year bond right now in the US. So what that does is it really does mess with people's minds if they're trying to buy. We've always been a quality house, and it's always, we've always wanted to own those kind of stocks, but sometimes the price value relationship breaks down, and that's happened in some of these internet companies where they're wonderful companies on great wickets, but when we forecast out the earnings and the cash flows over the next 5 to 7 years, they just don't make sense from a return point of view. So I think we never say never, but we're cautious on companies whose valuations have delinked from their great prospects, and that has happened in some of those internet companies.
Thanks, Nick. And just on Lake Charles and Sasol, there's been quite a lot of news flow recently. I mean, what are your thoughts on that? How you think it could play out potentially, and specifically in terms of shareholder value add?
Yeah, so we've obviously been giving it a lot of thought, and we have had a fair amount of Sasol previously. It's a very low weighting in some portfolios across Ford that have it. It's largely inconsequential from a performance point of view currently. We made a decision that the risk reward there also is not looking appealing in our minds. I'll take Lake Charles and the hurricanes out of it for now. They're doing an important job that they need to do to settle the balance sheet. The problem is they are selling what is a good asset at slight discount to what we feel it should have gone for. But that's what financial distress does to people. The one thing I will say is we are spending a lot more time on the oil price being a key driver in Sasol. And the more we think about it, the more we think the inflection point is coming closer than we thought. And we are becoming more cautious about our long-term oil price that we're inputting for Sasol. We think the electric car and other things will lead to a faster transition, and the peak is something that we're spending a lot of time on. So, yeah, not to dodge the question on Lake Charles, I think it was an important sale, but Sasol, given the risk return right now and our view of the oil price, has to a certain extent been significantly de-emphasized, and that happened a fair amount of time ago.
And Nick, moving to your kind of local government bond positions, the 2030s and 2035s, I mean, you obviously have done quite a lot of work on it and clearly believe that you will get your principal back. Just some of your thoughts on the default risk, especially given the state of government finances in South Africa.
So just to explain how it works on a government bond, you will not default on a government bond if it's in the currency that it's issued in. So what that effectively means, a lot of the defaults, when you look at Argentina and you look at the big marquee defaults, it's usually what happened is you have a currency that's, I guess, overstated, or it's going to depreciate significantly, and you issue a lot of bonds in a hard currency like dollars. And then what happens is you can't print enough of your local currency to pay back the dollar owner. So why that's important is a lot of our bonds have been printed in local currency. The risk there is not whether we get our money back. The risk is rather the risk that inflation gets out of control as the SA government have to print to give you your money back in local currency. I think the important thing now is two things. Firstly, the position size remains focused on the short to mid duration bonds. We have options on the longer duration bonds through to December, which look like they might finish out of the money, but that was one way we did it. We have a small allocation in my mind, given the risk to those bonds that you alluded to. But the important thing there is position size, make sure that they're not significant as a percentage. We will get our capital back. The biggest risk is inflation, and the inflation rate over the next few years is going to be very low. We've seen that the medical aids are not passing through an increase for 6 months. My kids' school have a 0% or 2% increase in school fees. There's going to be, a very stable inflation environment because demand is under so much pressure. We're watching the tea leaves, and we can react quite quickly and sell our small holding in the higher duration bonds if need within, I guess, an hour. So it's not something that we're too worried about. But the key there is to keep the position size small. The risk is actually inflation that we're worried about, and we're watching the tea leaves to see if that really gets out of control. For now, they're very much in control. The yield on cash is horrible. And I think even with a big blowout in some of those longer bonds, they still will outperform cash. And I could do the scenario analysis to prove how big it is, that substantial blowout in those bonds before cash outperforms those longer duration bonds. Sorry.
Okay, thanks, Nick. And yeah, the question about the US elections, obviously had to come up. And what would the impact be on markets if Trump versus Biden wins? And just if you can also break down of your foreign holdings, please.
I just missed you there. Sorry about. Just repeat that one.
The last bit was just about giving a breakdown of your foreign investments.
Okay. In what way? From the types of companies we own in our global funds, or
just
international? Which one was it?
Yeah, so the universe is obviously much bigger in South Africa.
There's the Ford International breakdown from the way it's structured currently. These are some of the stocks to allude to the. So that's that other chart where I've actually named the stocks. It was a confusing chart, and I didn't want to, spend a lot of time going through the stocks. But largely, Asian-focused tech companies is something that we really like because they were not nearly the same valuation in our minds that the Western stocks were. We have stocks like CVS and Activision, which are stocks that perform in a world whether we have a sell-off or not. Gaming will be strong. CVS, which is pharmaceutical, will continue to be good. Akebia is a biotech company, and Wheaton is the other one which I haven't spoken about. And this is not this is the top 10 performers over the period. It's not our top 10 holdings, but it just shows you where the performance came from. Wheaton is actually an interesting company in that they were the company that funded Sibanye in the streaming when they bought Stillwater. So they actually don't take the risk of mining, yet they get the upside to the precious metals. So where do we go? The next 12 months are very much not going to be like the last 12 months. The next 12 months, the important thing is to find companies that de-link from the market, as I spoke about. We have a company called Elanco, which is in the pet pharmaceutical side of things, which is a company that just had an activist take a stake in the last week, which jumped quite nicely. Finding pharmaceutical companies that are de-linked from the market. a company like Elanco, which the pet market is very resilient and there's a lot of upside from a margin point of view. Those are the ways we think that the next 12 months will come through. Protection, pricing power, good companies, and not linked to the, I guess, the cycle.
Thanks, Nick. There's actually quite a few good questions coming through as well, but we've just gone over 10:30. If anyone does need to drop off, thanks very much for joining us today. Nick, the next question is just about local rates in South Africa and potentially having quite a good impact on South African equities. What do you think about that?
Yeah, I mean, like with anything, rates on their own can't lift us into a growth mode. We need a lot more than that. And as I alluded to before, there are so many risks out there currently. The biggest one being the unsustainability, and I talk about unsustainability, as I said, it doesn't default necessarily, but the government bonds have the risk of being unsustainable. I'll use that word. So interest rates on their own do push people to be more animal spirit-like, and that's the whole aim behind an interest rate, right? Is the Reserve Bank or any Federal Reserve is trying to understand where neutral growth is in the world. And they try and pinpoint that number. And when they think that you're underperforming trend growth, they want you to be more aggressive. And when they think that you're overperforming your trend growth, they want to tame you. I think what happened was our Reserve Bank were very behind the curve. They used I forget the name of the model, or QPM model, or I forget the acronym, but effectively it was a backward-looking model in our minds that didn't adjust to where the world was in South Africa, actually, and they needed to cut rates quicker. So they've done the right thing now to be a lot more aggressive. Inflation is under control, but it doesn't necessarily mean that we're off to the races because of it. In fact, what we've seen globally is as the bond markets come down, it actually reduces people's animal spirits because they get a sense, in those kind of countries, and Japan, Europe, etc., have proven it, that negative rates and low rates aren't enough to stimulate an economy. There's much more important and more detail that needs to come through to make that happen. Confidence is the key one, that you need to get up, confidence to spend, confidence to invest. Interest rates is one of them in the mass, which we've spoken about it before, money for the market, interest rates, confidence and earnings, but it's only one of four pieces that gets that beautiful cycle that gets people to spend and grow.
And Nick, when we chatted to Dave recently on a recent webinar, he had quite a strong view about the currency and where it was going. What do you think about the Rand at the moment, and what do you think about the USD in terms of how you construct the portfolio?
Yeah, I mean, there's a lot of answers to that, but I'll try and keep it as simple as possible. I think the Rand will depreciate. We are a commodity-based country. We are a country whose productivity continues to grow way below most world markets. And if you do a purchasing power and any other calculation, the Rand will depreciate from current levels. In the current period, we helped quite a lot by the resource prices, the platinum price, the gold price. Our trade balance looks a lot better. Our current account through time will look a lot worse as dividends continue to flow out. Remember, every bit of trade balance that's positive currently that goes into Anglos and Billiton will eventually flow out as a dividend, which is an interesting concept because not really owned by South Africans. So, we celebrate a great trade balance, but none of it's actually due to South Africans because it's mostly foreign owned anyway. So the gist is that we think that the Rand will continue to weaken through time. And tactically, because of the flow of funds, because of Biden, you mentioned Biden, I forgot to answer something on Biden, but Biden probably brings a bit more animal spirits. I think he talks a good game like most politicians. He's going to raise taxes, but he'll raise taxes less than expected, and like good Democrats, he'll spend even more than expected. So the animal spirits will probably continue with him. And tactically, we think keeping that put option to protect a bit of Rand strength is the correct thing to do. But the foreign positioning will remain the core pillar because the opportunities in equities are the highest And we think that even with a bit of rand weakness, that'll be enough to make it the best place to be. The comment that I heard, I didn't actually listen to the webinar around Dave and his rand forecast. For any mathematician out there, if you go and do the maths, I'll leave you to it. It's quite a schooling in mathematics that led him to that number. So I will answer a question if someone wants a bit more detail on that, or I will leave it to someone to work it out and why it was an interesting comment.
Yeah, it just seems like, 100 to the US dollar. I guess we'll get there one day in the course of time. And
well,
Nick,
I think I wasn't on the call, but I think there was some date linked to that 100. And I think it was something to do with a 40-year, or can't remember the exact timeline. There was some, I can't remember the number. But if you do 4% depreciation per annum over that period, you get to that number quite easily.
Yeah, no, that's pretty spot on. It's nice to see that your internal views are consistent. And Nick, just, I guess, turning towards Ford as a business, just an interesting question that came up. And just given the state of South Africa at the moment, and unlikely that we're going to get kickstarted anytime soon, but what's the risk of losing staff in terms of immigration and people leaving the country?
I think it's got to be a risk. I think the main thing you've got to do is make it a good place that people love working at, that they want to stay, they want to benefit, and make the place interesting. The good news is we have a Singapore office that if anyone should want to move, we'll keep them within the Ford net. Hopefully they don't have to go to Singapore. It's preferable if they do. But if I wanted to leave today, I could just move to the Singapore office if need be. Not that I'm going anywhere, I'm very happy in South Africa. But the point is that having that net does help. But the lure of overseas is another big warning sign. I know someone that's on a Portugal WhatsApp group for people immigrating, and that number is doubling and doubling and doubling. Portugal is a go-to place for South African. Previously it was America, London, etc., with the burden of being able to afford to move there. There are other countries that are much more affordable, and South Africans are choosing to leave. So it's about creating this enabling world where we as South Africans are excited about the prospects to make money at the end of the day, and to obviously look after our families. So I think that's the biggest risk, is that that environment is not currently there, and the risk will continue until that environment is better.
Thanks, Nick. Yeah, I guess in terms of Portugal, I've seen some quite attractive property investment options for you to then go and become a citizen afterwards. But anyway, you can talk about that another time. So Nick, that's all we have time for today. Many thanks to you and the team for the great stewardship that you've demonstrated for almost 15 years now since managing the fund for us. And to our valued investors, thanks very much for your time and for your continuing trust in our business. We do appreciate it. A reminder that we will be hosting a session tomorrow morning at 10 with Omri Thomas from ABAX on the Nedgroup Investments Opportunity Fund for an update on the fund. And otherwise, best wishes to you for the rest of the day, and we look forward to seeing you again soon. Thanks, Nick, and thanks to everyone on the call.
Cheers, bye.